Welcome to the Passive Income Podcast. I am your host, Dividend Dave. Please be sure to join the Passive Income Posse by clicking that subscribe button below. Super excited for this episode. Joining me is Div Trader Drip. And so, yeah, go ahead and give yourself a little bit of an introduction, and then we'll get into having another amazing conversation.
Sure. So I'm Div Trader Drip on X, formerly known as Twitter. Um, let's see, I've been investing on and off for a couple decades now, but I mostly not investing. I just pop in for a little while, lose a bunch of money, and then jump back out again. Um, but this time I started earlier, probably near the beginning of the year, and I've been continually investing since then. So I've been through the 2008 crash and a couple other crazy events. And yeah, I'm from California, Southern California, Los Angeles area. Um, and yeah, that's pretty much me.
Yeah, okay, awesome. So, obviously, people know I'm in Canada, so we'll have a little bit of back and forth there between the differences and similarities between Canada and the US. But as the audience knows, we've had so many other American guests on here that that's kind of normal for these conversations. I am interested in a few things that you said right off the top there. Investing on and off for a few decades. So it sounds like you've done the same things that I've done, which is make so many of the common mistakes, and then maybe more recently getting into sort of having that more long-term mindset to just keep investing, just keep dollar cost averaging in. Um, is
Right.
that a fair assessment?
Oh, absolutely. Yeah. I made every mistake in the book, and I still make one here and there. So, and that's part of why I kept like quitting, right? Because I would, hey, I need to invest and build some income or build some, some wealth. And I would do the stupid things that everyone does, follow the meme stocks, or, like Blockbuster, GameStop, all that stuff. I jumped in. Um, Luckily, I didn't lose a lot of money, but I wasn't making any money either. So I just didn't want to spend any more time on it and jumped out. And I think, when 2008 hit, I wasn't really into the market a lot, but obviously I lost most of what I did have. And so I just
Right.
kind of panicked and sold. And, now I'm kicking myself because if I had just bought more, I'd have been a, much different situation.
Exactly.
Um, and so recently, the main reason I got back in is because, well, this year anyway, is because, I'm getting older. I'm in my 40s now, early 40s. And obviously, retirement is not too far away. I mean, 20 years, but it's really not that long if you think about it.
Right.
And I'm, just trying to come up with, build as much as I can before that. And so this time around, I have no plans on quitting. Even if tomorrow the market went down 40%, I'm still in it. I'm going to put more in. Learn from everything that I did in the past that was a bad idea, and try to maintain a more consistent investing strategy moving forward.
Yeah, a few excellent points there. Obviously, I'm a little bit older than you as well, so I'm quite familiar with all the market ups and downs of the last few decades. Even I was a kid back then, but I even remember like the 1987 Black Monday crash and how it was just like the sky was falling sort of thing, and then later on in the early 2000s the dot-com bubble, and then as you mentioned that 2008 financial crisis. And what you said was panic selling. And I mean, so many people fall victim to that, right? They see the market crashing and they just think, oh, I've got to like sell, sell, sell. But honestly, 2008 and 2009 were like some of the best opportunities to buy into the market, right?
Absolutely, yeah, no doubt. I mean, like I said, everything was in the toilet for the most part, right? Every stock you
Yeah.
could imagine was like a super fire sale going on, and I didn't think realize it at the time. All the smart people were like, "Hey, I'm buying in," but I'm like, "Nah, I've lost enough. I'm gonna get out."
Yeah.
And I should have listened to those people, but I didn't. So here we are. Now I'm kind of panicking, trying to build as much as I can. Later in life, and it's difficult, but I've with the advent of some of these newer ETFs and things that I've been getting into, like I feel like it's, you know, going to be a little bit easier this time around. I
Yeah.
think investing overall is just a lot easier nowadays. There's just so much information out there, and that was a big part of the reason I made those mistakes. Is I didn't do my due diligence like I should have, and now in the since I've started earlier this year, I've done nothing but watch YouTube videos, read articles. I mean, I've spent every free moment I have like researching not just stocks and ETFs that I'm interested in, but also just investing strategies in general. I learned about dollar cost averaging. I didn't know anything about that before. I learned. I'm just starting to get into options trading, which has been really great so far. I haven't been doing it that long, but been mildly successful at it, and I think it's something I'll continue to do because it's just an easy way to make money.
Right.
And then just learning about all the different the how to read charts and how to understand all the different. I mean, there's a lot. There's so many
Yeah,
different.
there is a lot when you get into reading charts like Fibonacci and
Yeah,
50 and
Bollinger
90-day moving
Bands.
averages, and like the list
Yeah,
goes on and on. And
RSI. I mean, when you go to like the charts on like Yahoo and you look at the metrics, there's like 100 different things you can pick, and I don't know 98 of them, right? So it's
right.
I don't know if there's anybody out there. If there's somebody out there that knows what all of them mean, I'm impressed because there's just so many, and they all are useful in some way, shape, or form to somebody. But
Right,
uh,
right.
it's just there's a lot of information out there, and that might be another reason why people are kind of hesitant. Is once they start going down the rabbit hole, it's really overwhelming. So you just have to kind of find what works for you and stick to it.
I'm just going to do some quick math here. You said you're in your early 40s, and 2008 was 15 years ago, so that would have put you into roughly your early to mid 20s, mid 20s.
Yeah.
And do you think maybe that was kind of part of it too, the mindset of being, in your 20s, and well, I think you already said not fully understanding the market and how the market works.
For sure, yeah. So I was young and obviously stupid back then, and I owned my own business. I was making a ton of money as a young guy, and I just blew it all on dumb stuff. Cars, booze, the usual things that 20 kids in their 20s blow their money on, and
Yeah,
and that was my biggest regret is not investing. Um, Even if I invested half of what I blew on stupid stuff, I mean, I'd be in much better shape. And whenever I meet younger people that are in that age range, I always like, they probably think it's very annoying, but I'm like, hey, take it from me, an older guy who's made a lot of mistakes, like, you know, save your money, invest it, don't blow it all on dumb stuff like I did because you'll regret it later in life, and you'll be wishing you had done what people had older experienced people had recommended you do, because when you're young you think you know everything and you think you're the smartest person in the room, and you
and you're
tend to
not.
discount exactly, and you tend to discount things that other people who have been around the block a few times say, especially older people, because you think, oh, it's different now for reasons XYZ, or whatever your rationalizations are. But at the end of the day, I wish I had uh, made those different choices. But hey, you can't change the past. All you can do is learn from it and make different choices in the future.
Yeah, move forward. I can relate 110% to everything you just said, though, about um, you know, blowing all of your money on dumb things in your 20s. The one thing I did spend a lot of money on in my 20s that I don't regret is travel. I traveled quite a bit, like trips to Europe, trips to New Zealand, driving back and forth across Canada, trips around parts of the U.S. So, um, though spending that type of money and making those memories, I don't regret. But yeah, there is a lot of other money that I just blew on dumb stuff, and
Yeah, yeah,
yeah, so
yeah,
I can relate to that part of it.
yeah. We all do. I mean, even now, I'll buy something. Clearly not as bad as it was when I was younger, but I'll buy something. Kind of on a splurge moment. I'm like, oh, I should have done that. So,
Yeah,
it doesn't happen often, but once in a while, it's you have that thing that you bought, and you're like, that was kind of probably not a good idea. Um, so, you just deal with it and move forward.
yeah. And so you also just made another great point is like, okay, you can't change the past, but from this point on, I can start to plan for and improve the future. And, that saying that we see on Twitter so many times is my future self will thank me. And it sounds like you're really focusing on that now, like making sure that, like you said, in 15 or 20 years when you want to retire, that nest egg is there, and you have that ability to do so.
Yeah, absolutely. My goal is, and this is very ambitious. I don't know if it's going to happen, but I'm, 65. Average lifespan is what, 75. For a male,
Yeah, up to
primarily because
80, I think, 78,
up to 80.
79. So
Yeah,
in that
because
range,
we tend to do dumb things which kill us earlier.
right?
Um, but so that if I retire at 65, and let's just say I live till at the average age of 75, I only have 10 years to really enjoy life, or not working for a living. So
Yeah,
my goal is I'm trying to be a little bit bolder right now to maybe build up more wealth earlier, so I can, instead of 65, maybe I can retire at 55, which is only 15 years. So, or actually, I'm 43, so it's 12 years
yeah,
from now, which I think it's not impossible if I'm smart about it, and I you know take some bigger risks. Like, I'm not investing a lot in, or really anything at the moment, in index funds, because those are long term growth vehicles, right? So
right,
I'm really going towards, the right now my portfolio consists, mainly of like Yield Max, Defiance, Cornerstone, CEFs. So, it's high yield, obviously high risk. So, it's not probably the smartest strategy for most people, right? Especially if you're younger, don't do that. Invest in the index funds and let it grow. But
yeah,
at my age, and I have some retirement, but for most of my life, I didn't work at a company that had like a 401k. So I haven't really built that up until the last 6 or 7 years. I started doing that.
right,
So it's not a huge amount of money in there. Certainly not enough to retire on. And then I had a Roth IRA for, I don't know, 7 or 8 years. But again, I was just doing stupid stuff in there. I wasn't investing it smartly, and so it would basically. I don't even think I've made much money in it, if anything, over the years, because I would just buy kind of I had some friends who work at like different tech companies, and they'd be like, "Oh, hey, I joined this company. You should buy the stock. It's going to go somewhere." And then I buy it, and you know, well,
and
they didn't even
tanks.
tell me to buy this. They didn't necessarily tell me to buy the stock, but I just did anyway because it sounded like it was going to turn into something, and it didn't. So,
Yeah, especially if they
you
get
know,
excited about it and they think
yeah,
it's all great, even though they're not pushing the stock on you, but they're like hyping up the company. So
right,
if
right.
if you're not doing your own due diligence and really looking into all the financials of the company, then yeah, I could see how you could end up going down the wrong path on something like that.
Right. Yeah. So that's another lesson I learned, which is, like, as you said, do the due diligence. Um, make sure that and it's not even like picking the right stock. It's just at the bare minimum, understand what it is you're investing in, right? Like,
Right.
whether it's an ETF or a company, understand what they do, understand the business model. Is it sustainable? Is it going to, uh, you know, is it managed effectively? Do the people in charge know what they're doing? Things like that. And that's just as important as looking at the charts, right? Because
Yeah.
a company that has a strong foundation, is going to be better off than flavor of the week.
Yeah.
Uh, so I think the only thing I ever did invest in that went anywhere was Apple. That was probably the one stock I had in my IRA that did well, because obviously they're a good company. They
They
make good
perform
products.
well every year, right? People are
Yeah,
buying more
absolutely.
iPhones and all their other products, Apple Watches and everything else every single year.
Right, right. So, I'm still new. I'm still learning, even after all these years. And so, I don't always pick winners like everybody. And
Nobody always picks winners, right? Everybody's got
yeah,
dogs in their portfolio, but everybody likes to talk about the winners and not the dogs, right?
right. Yeah, absolutely. So, for me, it's been mostly dogs in the portfolio.
I can relate to that
Um,
too.
yeah, I'm just trying to turn that around and make the best decisions, for me anyway. And there's another lesson I learned is there's so much financial advice out there on YouTube and other places, and most of it I feel is bad, because everyone's got a different situation. So, you
Yeah.
know, what works for you may not work for me, and vice versa. So it's really if there's one thing I would recommend to people who are getting into investing or like me, maybe have been around the block but are still not sure what to do, um, I think just focus on what you think is best for you and don't listen to all the
All the
the
noise.
all the noise out there. When I first earlier this year got back into investing, and I was spending a lot of time on YouTube watching videos, and you see those videos. It's like, hey, invest in this ETF now, and it's got like that graphic with like the chart going up, and you think, oh, what's this all about? And then you look at it, and it's just someone pitching some ETF or something. And if you're consistently like trying to change your strategy based on all these different things that you're reading, then you're never going to go anywhere. You have to like uh, you know find something that works for you and just really stick to it, right, consistently. Uh, and so far, that's been working for me. I mean, I've been uh, doing fairly well since I've came back into the market. Obviously, October, September was a little, that was pretty bad for everybody. But it's I'm definitely doing much better than I was, you know, before.
Yeah, you made a couple great points there. Personal finance is personal, and so that's a you know so important that you know my personal finances and your personal finances could be completely two different things, and so you really have to find what is going to work for you, you the individual. And then you also, I love this too, the part about there is obviously there's tons of great YouTube videos out there about investing and finance, but in every single one of those, including this podcast, we always say not financial advice, right? So
Right. Yeah, that's true. Yeah, they do say that. But people, myself included to a degree, we're always looking for like something new and exciting, right? So you're watching these videos and you see, oh, this is cool ETF and it's, got this high yield and, et cetera. And, you can easily, get convinced by these videos this is a good play, just, based on what they say. But, with anything in life, you have to look at the counter arguments as well. So,
right,
you know, when you look at it, watch a video and that says, hey, this ETF is great, you should buy it, then go look up a couple of videos that explain it from the other perspective of why it might not be a good buy, and then you
right.
make your informed decision
Weigh the
based
pros
on
and
that.
cons like any decision, whether it's buying stocks or ETFs or buying a car. Like you need to weigh the
Right.
pros and cons of every decision, right?
Exactly. You have to just due diligence. I think applies not just to investing, but just to your life in general. So you know, like you said, buying a car, buying a house, all these things, and that's the funny thing is people typically do those things right when they're doing those other things in life. I would say for the most part, people tend to do the due diligence, right?
Right.
They, when you buy a house, you get it inspected, and you do all the stuff that you have to do to make sure it's a good buy. When you buy a car, you'll go on, whatever I haven't bought a car in a while, so I don't know where people go these days, but CarMax or whatever, right? You're going to go look for a good price and etc. But then when it comes to stocks, it's almost like people shut
Or
that part
just
of their
throwing
brain
darts
down.
at a dartboard.
Yeah, they're like, hey, I'll go put $10,000 into this ETF I just heard about on YouTube last night, and they'll just without even thinking about it. So to me, that you know doesn't seem very consistent.
Right.
And look, hey, not that I'm the most perfect person in the world. I've certainly done stupid things like that in the past, but um, you know, it's it's something that I'm trying to get over, and I think I've done pretty well. I've been since I've obviously been reading and watching more. I feel like I've made better decisions overall.
Right.
But again, it hasn't been long enough to know if that's how it's going to play out because like I said, I've only been back in it for probably since April. I think March, April timeframe is when I started investing again. And like I said, so far it's been doing well, but investing is a long term game. So
Yeah.
um, I would say for another couple of years, it wasn't really going to give me a very good insight. And obviously you look at it and you can make adjustments, but um, we'll see if I can get if I inch closer to my goal, I would consider that a success
Yeah.
over
Good.
time.
I'm gonna kind of Well, take it to the end of your username there, drip, which is obviously dividend reinvestment plan. And I'm just going to point out that I'm sort of in a similar situation. I'm a little bit older, at 50 years old, and I'm hoping that I can maybe retire at 60, so 10 years down the road. You've got that 12, possibly 15-year time frame. And if I work to 62, I guess that's also a 12-year time frame to retirement. And so, anyways, going back to the drip part of it, are you really focusing on like dividend paying stocks and then just reinvesting the dividends and trying to grow that, get that snowball rolling?
For sure, yeah. So the well, yes and no. So with funds like Cornerstone, I don't know if you're familiar with Cornerstone.
I am not.
It's a CEF closed end fund. It's been around for like 40 years, so it's very mature. But there's two funds. They have CLM and CRF, and they have 21% dividend, and they have what they call a drip at NAV, right? So, are you familiar with CEFs at all? Closed end funds?
I'm not
No.
not as well versed as I should be, to be honest. Yeah.
Okay, well, I'm not an expert, but I know enough to know that they basically they typically have a premium price that's could be above or below the NAV, right? So you have like the net asset value of the fund, and then you have a premium which is driven by price action of the shares, because the shares there's a certain number of shares. They don't grow the shares like an ETF does. So there's 100 million shares as an example. That's the number of shares they have until they do something like a rights offering or something. But regardless, that price action drives the price of the shares up and down, irrespective of the NAV. And so when you get your drip shares, they actually, depending on your brokerage, they'll drip it at the NAV price and not the market price. So if the NAV price is like $5 and the share price is $7, you instantly get a gain of $2 per share.
Right.
When they drip it. So, and I discovered this fund recently, and there's a lot of, the thing about the fund is there's a lot of people that love it, and there's a lot of people that are like that fund's a waste of time. You're not going to make any money. And I've read both sides, and I tend to agree with the people who have been in the fund for 5 years longer and have made a bunch of money on it. And it's not a fund you can set and forget. You have to maintain it a little bit. But
Right.
regardless, in that fund I'm dripping, but like the yield max and so forth, I don't drip those because I only buy those funds on the ex-div day, because the price drops
Right.
by the dividend amount. So I'll basically, have the fund set to drip to my cash core on the ex-div date. I will buy the number of shares I want to buy for that month. Typically, it's like 100 shares or something like that.
Mm-hmm.
And then I won't buy any more until the next div date, ex-div date, or if there's a huge market drop. Like there's a couple times in September, October that I bought because the market went down. So yeah, I definitely drip, and then I guess I would call it manually dripping the other funds, because I'm not letting the broker purchase the additional shares. I do it myself.
Right.
But I'm continually buying more and more as time goes on, and just collecting the premium on the Cornerstone funds. And then another thing I've been doing to accelerate my growth has been starting to use margin, which is, for anyone who doesn't know what margin is, it's a loan from the broker, and they basically give you a certain amount of equity based on how much equity you have in the account. So say you have $100,000 in the account, and they give you 100,000 more. Typically it's 2 to 1. So whatever you have, it's double, right? So you can borrow up to 100,000 more, and then you pay an interest rate every month, and you can buy whatever you want with it. So I've been using the margin to accumulate more shares of these high yield funds, and then the yield I get from the funds is higher than the interest rate that I'm paying. So basically every month when that drip comes in, it pays down, or when the dividend comes in, it pays down the margin. And so that's been a really good way for me to leverage myself to accumulate more shares of these funds. And then over time, that debt's going to pay itself off, and then I'll be flush. And then from that point, it'll just be house money. So
That's great.
kind of my
That's working
strategy
for
right now.
you. Do you want to maybe just explain the risk side of that as well?
Absolutely. So margin is definitely very risky. So how margin works is, as I mentioned, you get a certain amount of additional funds based on your account equity, and as I mentioned, by default it's 2 to 1, so you can extend yourself 100%. Now, with that comes what we call margin maintenance, which is essentially each fund, and this is also brokerage specific. And when you have a stock or an ETF in your account that's purchased on margin, you have a certain what they call maintenance number, which is a percentage usually. Say it's like 30%. So that means that uh, if you buy that stock, then the maintenance amount is going to mean that you have to have that much equity in that investment at all times. And if you go below that equity number, then it's called a margin call. And then the brokerage will give you typically a certain number of time to either put more money in the account or sell shares to get back to where you need to be.
Right.
And if you don't do that, then they'll sell your shares for you just to get their, to get you back in compliance. And so the risk there is that if you don't, if you're buying stocks that are depreciating a lot, or if you say there's a black swan event in the market and it just goes down like 40% on a day, that could drop you below the margin requirement, and then the brokerage, if you can't make that up, the brokerage is going to sell off your shares, and then you're going to lose a lot of money. So
Right.
uh, it's definitely risky, not for everybody, but for me, it made sense because, like I said, I'm trying to uh, accumulate more in a shorter period of time. So that leverage was important to me to try to achieve that.
Right.
And I have, I don't, I'm very careful about how far I leverage myself to where if the, let's say my account dropped 30% on any given day, I try to make sure that I'm within enough of an equity level where that wouldn't cause me to have a margin call. So you have to watch your equity percentages and make sure that you can sustain a pretty, decent sized market drop and not have to go into margin call.
Yeah, thank you for explaining that. Very interesting. It definitely does sound a little bit risky and obviously not for everyone. But if you are using it and making it work for you, then all the better for you, right?
Yeah, exactly. It's a personal decision. Margin has a lot of benefits, despite the risks. It doesn't show up on a credit report. If you want to get rid of the margin, you just sell the shares. So it's easy to get rid of margin debt as long as your shares are still valuable. So in many ways, I would say I've heard of people taking out like HELOCs on their house to buy stocks, and these other means to do that. And I just, if it comes down to like taking out a HELOC on my house or using margin, I feel like margin's the better play there. Even though the interest rate, I'm at Fidelity, and I think the margin rate's like 13%, which is fairly high,
Right.
definitely higher than a HELOC. But at the same time, I get the benefit of not having to take equity out of my house. It doesn't show up on my credit report. And, if I want to get rid of the margin debt, like I said, I just sell the shares that I bought on margin, and, it's
Right.
gone. So I would say for someone who's thinking about borrowing money to invest, which I mean, to me is smart, depending on how you do it. Um, and you're thinking about a HELOC or something similar, like a personal loan from a bank or something like that, um, you might want to think about margin instead. And Fidelity's E-Trade and a couple of those brokers, the major ones, have pretty, I would say kind of high, 13%, 12% rates. There's other brokers out there that are much lower, like 6%. So if you're looking to borrow like a large amount of money, then you might want to look at the brokers that have the smaller number margin rate.
Right. Yeah. The home equity line of credit would obviously have a lower interest rate. However, we've seen what's happened with interest rates over the past uh, two or so years, and yeah, that's very interesting. Very interesting take on basically using someone else's. Well, I guess in the home equity, it's sort of kind of your money because it's equity in your home, but um,
Right.
yeah, that's very interesting take on a way to just accumulate just that initial cash? Or
Yeah, it's just a quick and easy way to basically double your purchasing power. So, you know, keeping in mind the margin requirements, of course, but typically you can leverage yourself out, at a minimum 50%.
right.
So if you wanted to, buy more ETFs or stocks and you don't have the cash flow, you can just, apply for margin. You typically have to apply at the broker, like you would for any other credit, and they ask you some questions like your income and your trading experience and yada yada. And then if you're approved, you then get the margin. It usually happens within a day or two, and then you can go and use it as you would cash. So when you buy the stock, you can typically choose whether you want to buy it in cash or margin, and then it goes ahead and makes that purchase for you. So it's just super easy to use, which might make it even more dangerous, but at the
Yeah.
same time, it's very useful, especially if you're doing like options trading. You can trade on the margin instead of your own cash if you want to do that. So
Yeah,
lots of
which brings
uses.
us to the next part of your username, the trader, div trader drip. So you mentioned that you have been doing some options trading, and I'm guessing, I don't know, maybe some swing trading as well. But I guess let's just talk a little bit, if you wouldn't mind, sort of about how the different types of trading are going for you.
Yeah, no doubt. So I've been doing options trading. I started experimenting, I think, back in September with options, and options is a whole another world of trading that, again, there's so many different strategies and different types of options trading, and it's really one of those things where if you're going to commit to doing it, you should definitely invest a lot of time just understanding how it works, because it's easy to make money, but it's also easy to lose money. Um, and so what I've done is I've just, again, spent lots of time watching videos on, how to do calls and puts. And, I only know like 5% of what of how to do options trading. I saw you had Leah the Trader on your show
Yeah,
recently. I follow her on Twitter. I love Leah. She's awesome. She does really good,
yeah,
like videos and stuff on YouTube. So, just find some people like that on YouTube who know what they're doing and just understand like how options works, and then start small. Do like a couple of very low low value stocks. Do a couple like what I typically do is cash secured puts right now. And I'm working on the crypto stocks because they've been consistently going up over the past couple months. So two of my favorites right now are Marathon and Riot. So I've been doing weekly cash secured puts on those stocks, and I'm getting usually a couple $100 a week in premium. And so you basically sell a couple. You can start with any small stock. I think I did like MPW and a couple like $4 or $5 stocks to kind of get my feet wet, right? Because if you
right.
lose, you're losing not as much if you do lose. But typically, I did some puts, I did some calls, kind of figured out all the things like the delta and all the gamma and all the different Greeks. I learned what the you how to do the cash secure puts, covered calls, and you can even do there's like iron condor, and I mean there's so many different like options trading strategies, and I don't even know most of them. I'm not at that level yet, but so far it's been pretty good. I haven't really, luckily, knock on wood, I haven't really made any really bad options trades yet. I'm sure I will at some point, but so far, and I think the fact that the crypto stocks have been continually going up, which is why I'm doing, cash secured puts, because those are a bullish play.
Right.
Um, and so I haven't been called yet, so I haven't had to take ownership of shares. Um, but even if I did, I could just then turn around and sell covered calls on the shares that I got, and still make money off of it. So that's what I've been experimenting with, and just trying to get more knowledgeable. And so I'm hoping that income is going to grow over the next year, where maybe instead of making $200 a week, then maybe I'll start making five, and then 1,000, and then
Right.
go from there.
Yeah, interesting. So in addition to Leah the trader, I've also had options trading Chris on here, and I've been on his channel as well. And yeah, I know so very little about options trading, and they were throwing all of these terms and terminology and different words at me, and I'm just like,
Right.
your head starts spinning real fast because, like you said, even just trying to learn that first 5% of what goes into options trading, it's a whole different animal compared to just like just buying shares in a company and just sitting on them for and just like it's so different.
Yeah, it's a whole different thing. It gets complicated too because there's a lot of obviously that's where you have to start learning reading the charts and really understanding the technicals. When you buy and hold, typically don't have to deal with that too much, right? Because hey, I really like Tesla, I really like Apple, whatever. I'll buy the stock and I'll hold on to it for 10 years. And if you're a long-term investor, you don't really care about the technicals because you're confident that over 10 years, Apple's going to go up and or
Yeah,
Tesla's going to go up. Whereas with options trading, these are typically short-term trades that you're making. So you have to know that hey, if I buy this stock with a cash secured put, if I don't want to own the shares, I just want to collect the premium. I'm betting on the stock going up, right? So I have to be reasonably certain that what I'm putting this put on is not going to go down, and that's why I've chosen the crypto stocks because they're on such a hot run right now that
right.
they've had some days where they've gone down a little bit, but for the most part, it's like every day they go up. And I'm sure that's going to come to an end someday, and then I'll probably be holding the bag maybe if I'm not smart. But to me, it's a safe play for the foreseeable short-term future on
Right.
those types of stocks. But I think if I didn't have that right now to sort of take advantage of, it might be a different story because I'd have to look at other things. Like maybe some of a lot of people play like Tesla, Coinbase, underlying stocks, and some of the other, Apple, and I'd probably have to do those, which is still, Apple and is a pretty stable stock. So, if I did a put on Apple, I'd be reasonably certain that Apple's not going to tank like 10%, right, on any given day. Um,
Right.
so I'd probably choose safer stocks, but at the same time, those safer stocks don't pay as much premium, right, because they're less volatile. So I'd probably be making less, but I'd be investing in kind of stronger stocks. Um, so that's why I've done the volatile stuff now because higher premiums, but also higher risk. But at the same time, they've been performing so well that it hasn't been an issue yet. But I'm imagining at some point, I think a lot of it's going to hinge on whether the Bitcoin ETF is approved or not. So I suspect things will continue to creep up until January, and then if SEC approves Bitcoin ETFs, all the crypto stocks will probably fly even higher. And if they don't approve it, then at that point, it's probably where everything's going to go down again. We're going to have another Bitcoin crash,
Yeah.
potentially. I don't know. I don't ever try to predict the market because nobody can and nobody
Nope.
ever has. I feel like every time they go, oh, this guy predicted this. And it's like, well, he predicted it for like 10 years and then finally it happened. So it's like,
Yeah.
if you predict the same thing enough, you're eventually going to be right. So I don't typically listen to those proclamations that, oh, I predicted this crash because, you predicted it, you know, every day for so long that
Eventually, you're going to be right when you just keep saying the same thing
eventually you're
over
going
and
to be
over
right.
again.
Yeah. And so I always
Here's
hear
my
people go,
prediction
oh,
for the stock market in 2024. In
yeah.
2024, the stock market is going to go up, or it might go down.
Right. Yeah. It's one or the other, right?
Yeah.
Um,
So
yeah.
I
That's a
guess it
great
could
prediction. I
trade
mean,
sideways also. So
right. Well, see, the nice thing about that prediction is it's guaranteed to be correct. So, uh,
right.
you know, one of those options is going to happen. Um, and so, yeah, and that's the other thing I've learned is, whether it goes up or down, you just stay in it. And that's my goal. Like I'm going to stay in it for the rest of my life, probably. Um, unless I make millions of dollars, I just cash out and go live on an island somewhere.
Right.
but for the most part, um, I'm going to be in it, whether it goes up 20%, down 20%, or anywhere in between, or over that number.
Right.
Just because, you know, I know it's cliche, but time in the market is going to be timing the market,
Yeah.
because nobody can time the market, but no matter how hard they try. And if you do, you got lucky.
Yeah.
It wasn't because you had some kind of insight that nobody else had.
And that's what we know over that 20-year time span is the market always goes up over that. Like there's never been a 20-year time span where the market has gone down.
Right.
Like sure, it'll go down for a year, maybe even 2 years in a row, which is not usually the case. But over the course of 20 years, it's going to go up.
Right. And that's a great point. And that reminds me of something I saw on X. Are you supposed to call tweets X's now? I don't really know how that works, but
Who knows?
somebody X'd a tweet, and it said like they showed a chart of the stock market. I think it was S&P, and they basically said like, 10 years, the market may seem high now, but 10 years from now, you'll be like, I wish the market was still
Yeah.
was still what it was back then, what it is right now. So it's like now, even though it's really high, it's still on a long-term outlook. It's still a great time to buy because, like you said, give it enough time, it's going to go up eventually. So, there's never not a good time to buy.
It's like everybody does. Oh, I wish I had bought Apple or Microsoft in the 80s, and it's like,
right.
Yeah, that would have been great if you're still holding it 40 years later. There's probably about a 99.9% chance if you did buy either of those in the 80s, you wouldn't still be holding them.
Right.
And so, yeah, but kind of the same idea, right? Buying right now in 2023, almost 2024, and 10 years down the road into 2033, 2034, odds are very good, almost guaranteed. I don't want to say it is guaranteed, but almost that the stock market even over the 10-year time span will increase, probably significantly.
Sure. And I think the only time that it didn't was, I think I saw that between 2008 and 2000, there was like a 10-year period where the market was relatively sideways.
Flat,
right?
Yeah.
I think 5 to 10 years. I can't remember the time frame, but it was a short period of time where the market didn't actually climb a lot like it normally would.
Right.
But even if you take that into account, once we got past that period, it went up some more. So, it's over a long enough time frame, you're going to win if you stay in it. If you cash out, you're definitely not going to win. So
right.
That's why it's always funny when, a stock goes down and people panic sell. And again, I'm guilty of this myself, but now I'm smarter. I'm older and smarter. And it's like, well, and it may even be, I may even be stubborn to a degree, which is if a stock that I bought tanks a lot, I'll still hold on to it because the loss is not locked in until I sell it. Right.
I'm guilty of that one
so,
too. Actually, just yesterday I sold off one of my dogs where I was finally, I'm just going to cut my losses on it. And of course, now that I've sold it, it's probably going to skyrocket back up in the next year. But
yeah, I was joking about that because I'm like, hey, if you want to know what to buy or what to not buy, just buy. Don't buy what I buy because it'll go down as soon as I buy it. So I totally feel that sentiment. But yeah, it's just knowing when to cut your losses, and I think that's another fault of mine, which is I sometimes I don't know when to call it quits on a stock. So if I buy something at $10 and it goes down to $5, I'll be like, oh well, like the one number one, I'm never doing an IPO again. That's a big mistake.
I would agree.
But I did do the Backblaze IPO a couple years ago. I don't know if you're familiar with Backblaze. They're a backup company, and I've been a subscriber of theirs for, I don't know, 10, 15 years, whatever. It's been a long time. So I was like, oh yeah, I love this company. I've used them forever. They're going to do great. I bought their IPO. I think I got like, what was it? Like $15 a share, something like that. And then like almost a month, a couple weeks after it IPO'd, it went down to like $4 a share.
Right.
So luckily I didn't put a lot of money into it because they limited how many shares you could buy, which was probably a good thing for me because I might have bought more than I should have. But then I sold it for a loss just recently, and I held on for forever because I'm like, all right, I got into the IPO and I want to make my money back, and the stock, it just wasn't going anywhere. And then I finally just got rid of it. And then of course, after I got rid of it, it went up, not by a lot, but it did go up a little bit.
Yeah.
And so, now I feel like I should have hung on to it a bit longer, but it's probably better that I got rid of it because then I don't have that hanging over my head.
Yeah, my feeling on IPOs is that it'll come out on whatever given morning when the bell rings, and then the day traders just drive up the price on that initial morning, and maybe into the early afternoon. The day traders all sell off, and then that's it, right? Then it
Right.
starts to tank the next day. Generally, what happens from what I've seen on an IPO, again, I'm not an
Mhm.
expert on that, not financial advice. I just seems to be the trend I tend to see when any company IPOs.
Yeah, that's definitely, I think, true. But it also depends on the company as well.
Yeah, for sure.
Some IPOs, it's rare though, right? It's rare that an IPO is going to go up and stay up. And even I think even Facebook after an IPO, like it went up and then it went back down, right? So it didn't, skyrocket and stay
Right.
going up after that point. So yeah, like 90% of the time or more, you're going to lose money in the short
In
term
the
anyway.
short term, yeah, you look at Facebook, and
Yeah.
if you're still holding on to that 15 years later, I'm sure you've done quite well. Um,
Absolutely,
yeah,
yeah, yeah. But again, that's a level of patience I think a lot of people, including myself, may not have. So, if I have a stock and I've been holding on to it for, a couple of years and it hasn't moved, um, my stubbornness can only go so far.
right. Yeah, yeah.
So
I feel that
we'll
sentiment
see.
as
But
well. Definitely just kind of want to the overall picture I'm getting from you, and truly really enjoying this conversation. But you definitely have a high risk portfolio, high risk, high reward. So you definitely have that risk tolerance just built in. Is that a fair
yeah,
assessment?
oh yeah, yeah. I have a high risk tolerance. I obviously, given the fact that I'm trying to build up as much as I can in a shorter period of time than most people, the younger people have.
Right.
I don't feel like I have much of a choice but to be higher risk because, as we all know, more risk, more reward, right? So I could, just dump my money in VU or some index fund and let it, go up 10% a year, um, which is the safe bet. But my goal is to go beyond that, and then accumulate as much as I can. And if I can get enough dividend income per month by a certain point, maybe even just live off of that
Yeah.
and continue to do options trading. So that's really my goal, and that's why I'm in such a high risk portfolio, which obviously I wouldn't recommend to anybody who's not, you know, uh, the stuff I'm in. I wouldn't recommend to anybody who's not or who is risk averse.
Yeah.
Um, but that's just the way I'm playing it, and maybe it'll work out, and maybe it won't. Like I said, I'm in a lot of Yield Max, I'm in a lot of Defiance, which I know are new. They haven't been around that long. Yield Max has been around a year. Defiance has been around 3 months now, something like that. So far, I'm doing really well in those. Like I said, I only invest on the ex-div date. I reinvest, the money manually on those days, and so far I'm up. I think on the Defiance I'm up like 4 or 5% so far in total. If you include the dividends, right, in the total return, which I think a lot of people don't necessarily do when they look at
No,
some of
and
these funds.
I'm always the first to say dividends are part of that total return. You just happen to be getting them
Right.
on a monthly or quarterly basis, right? Like you're
Exactly. You got to include that. So like they'll look at the chart and they'll see like Tesla or, well, Tesla is kind of an extreme example because it really tanked when Tesla went down. But if you look at like Coney, I'm doing fantastic on Coney. The NAV is up. I think, just without divs, I'm up like 10, 12%.
right.
If you include, it's way more than that. And so, I think Coney is an example of a yield max fund, of what a yield max fund could be if the underlying is really strong or doing really well. And so that's why I'm optimistic that, some of those funds, I think could really be great for somebody who's looking for solid income. But again, the Coney gravy train that might come to an end at some point, right? So it's not guaranteed to be that good forever. Tesla, Tesla's a roller coaster. It could be up, it could be down. Who knows, right?
Right.
So that one, is pretty risky, and I'm not in the green yet on that one, but I'm hoping, I think within the next month or two, I'll finally be in the green, and at that point, it'll be, I think, unless Tesla really goes down, I'll be fine from that point. So yeah, and then the Cornerstone, I love those funds. I mean, they don't move a lot because they're very uh, they're based, they have like they're index like, right? So
Right.
they have similar holdings to like the S&P. So they sort of follow the S&P. The premium could go up or down based on certain market actions. Like in September, there was a pretty big drop in those funds because there was an institutional holder that sold off like half their shares, and it drove the price way down. And a lot of people that were in it like panicked and sold. But then now it's back up to, I think it went from like 8 something down to 6 something, like 630 or whatever, and then now it's back up to like 740. So
It's
you know
recovering.
it's recovered somewhat, and I think moving forward, it'll get back to where it was. Um, but yeah, high risk stuff. That's my plan. Again, I wouldn't recommend it to anybody who's not risk averse or who is risk averse.
Right.
And but if you're looking for income, that's the way to do it. At least in my opinion. And again, these are new funds. I kind of feel like Defiance is better plays because they're obviously based on the index and not a single stock. So you don't have that risk of like, if Coinbase tanks 20%, right, then Coney's going to drop in kind. Whereas, with QQQY and JEPI, those are based on the indexes, which, they could have a black swan, right?
Sure.
That's always a possibility. But for the most part, they move very little day to day. And the returns have been great, 60% yield. So there is that high yield. And of course, the NAV does move a little bit up and down. I think like depending on if it's a great month, the NAV will recover. Like I think November, uh, they kind of the NAV got back up to roughly where it was before the dividend, and then the next dividend payout obviously brought it back down. Um, but regardless, those are probably my favorites right now, the Defiance funds. They just came out with the Russell IWMY fund, which is based on the Russell index. And again, nobody can predict the market, but the common wisdom is that once the interest rates go down, that's great for small businesses, and then the Russell will supposedly go up. I don't know if that's true or not, but we'll see.
Yeah. Before we wrap up, I see we're already well over 50 minutes. Great conversation. Totally love having you here on the
Absolutely.
Passive Income Podcast. Before we wrap up, do you have any kind of final thoughts, or just the floor is wide open at this point? Anything else you would like to say?
Um, I don't know. Like I don't want to give any advice because obviously I'm not the smartest guy in the room. I'm just letting everyone know what my strategy is. It works for me. It may not work for you. Um, if just keep at it. Create a plan and stick to it. At least that's what I think works well for me. Is don't change your strategy based on the new thing or the new YouTube video
Right.
recommending this hot new stock. Just come up with a game plan, come up with a strategy that's going to work for you personally, and stick to it, and just avoid the noise. Don't listen to all the yahoos on X and YouTube and everything. Just spouting nonsense.
Right.
Uh, and yeah, you'll be fine. Just stay in it, whether it goes up or down. At least that's my plan anyway.
Yeah.
And I really appreciate the conversation here. I also had a great time. I think I told you earlier, this is the first time I've ever been on a podcast, so this is pretty cool.
Yeah.
Especially when you've had such esteemed guests on here, I kind of feel like a nobody. So appreciate you giving me a platform to kind of speak my mind and talk about investing, which I love this topic. I could talk about it all day.
Yeah.
I probably annoy my friends because like when they come over to hang out, I just talk the ear off about investing, and they're like, "Will you shut up?" So it's nice to like talk to people who are as excited as I am about it. So
Yeah, and that's a big reason
really
why
appreciate you.
I do this is I love talking to people about investing as well. And like you said, I've had so many great people on here, and I've had so many incredible conversations. And that's another part of it too, is giving people like yourself a platform as well. Like it doesn't just have to be the people with 100,000 followers or 50,000 followers on Twitter/X, right? It's everybody. Whether I've had guests on here that have had literally like 5 followers on X, and I'm like, doesn't matter to me. I just want to have conversations with everyone and sort of give everyone a voice to um, sort of share their journey, their path, their strategies, and to add to what you said, yeah, create a plan that works for you. To reiterate, personal finance is personal, and yeah, just create that plan that works for you and stick with it.
Absolutely.
Absolutely.
That's how to do it.
Before we sign off, I'm just going to give a quick shout out here to Patrick at investingshirts.com. You can see there on the ticker, you can receive a free Passive Income Posse Turn That Cash Register Around coffee mug with any purchase over 100 Canadian dollars. I should add in the CAD in there before taxes and shipping at buyinvestingshirts.com. Use code word Posse for a 5% discount on your purchase. And the link, as always, will be in the description. So shout out to Patrick over there at buyinvestingshirts.com. Thank you so much to Div Trader Drip for being the guest on episode 123, episode 123 of the Passive
Oh,
Income
wow.
Podcast.
That's awesome.
Awesome. And if
Well,
you're
thanks
still
again
here,
for having me. Appreciate it.
oh yeah, thank you so much. And also, obviously, if you're still here nearly an hour later, please be sure to like and subscribe.